That's exactly it. So there is other things to this deal as well that, certain people overlook, right? So there's, for instance, on this one, none of the parking is included in any leases and they're not charging for parking. Something we can do right away is just, start charging for parking. Okay. So we can go out and make a couple $1,000s a month just on parking. 12 storage units, actually in this building, completely underutilized. They're just, it's a mess in there.
Welcome back to the Money, the Mindset, the Mentoring podcast. Today, we've got Matthew Phipps with us. He is here. He is an investor real estate out of Kitchener-Waterloo in my neck of the woods. There's many times I get to talk to people in real estate, but I'm so excited about today, dude, because we actually get to talk about local real estate where I live. And Absolutely. That is so super exciting. A lot of times I'm talking about real estate in Nebraska, in real estate in Florida, in Tennessee, all these different spots, Ohio. But now we actually get to talk about real estate in Kitchener-Waterloo, Ontario, Canada. And Matt, you are so deeply entrenched in the investment side. And so specifically today, we're going to be talking about real estate as an investment, not necessarily as a home. So Matt, welcome to the show, brother.
Thanks, man. Glad to be here. Really excited to talk about Waterloo region, talk about, my experience, what we're focused on, where we're seeing opportunities. Really happy to dive into this today with you.
A lot of times we hear people talking about the only way to make money in real estate is to buy properties, sell it all in Canada, take the hit, and go buy properties in the United States. What do you think about that?
We're hearing a ton of it these days. Obviously you see a ton of it personally. We've all got clients. We've all in the networks where everybody's talking about going down to the States, the higher cap rates, the cheaper cost per door. You hear all of these things. To me, there has always been opportunity in Ontario. And in our local market, there's always been really good opportunities that we've been able to find. I find them very stable. I find them predictable. And quite honestly, a big thing for me is it's the market that I know. So it's where I can identify value. Like a big part of this is just really knowing what a deal is. And because I know this market so well, we can identify a deal in this market.
I've heard, we were at a conference a little while ago, Expand, and that was one of the things that was said was, there's deals everywhere. And it doesn't matter whether it's California, Florida, or, Kitchener-Waterloo, Ontario. There's a deal to be had. It's the job to go look for the deal and make sure that it makes sense for you. And your approach of using the Warren Buffett approach of saying, I'm going to, work with what I know and invest in what I know is a really solid way to look at things. Because then if you know it, you know exactly where the pitfalls are and where the opportunities are. Plus, a lot of people will talk about, the pain that happened in the past few years around declining values, increase in interest rates, and being able to try to find something that can actually be cash flow positive.
Yep.
What are you seeing for real estate these days, and how are investors making decisions based on what they're seeing in the market today?
Yeah, I think that, when everything was going crazy in the market, we really saw everybody come up with these kind of extravagant plans to add value, these complicated deals where they're really trying to force stuff to make it happen, because it was really challenging to go out there and just find a good deal with good fundamentals that just made sense from day one. So you'd go in there, you try and do these cash for keys, you try and renovate, you try and do all of these things to add value to make the deal outside of what the opportunity in the market presented. These days, I find really the best deals in the market, and where I'm focusing personally, where we're directing our clients a lot of the time, is to just the good basic deals that just have, good fundamentals to them, right? We're kind of going back to basics. It takes a lot of the risk out of it. And we're not saying, this is this super sexy BRRRR project where you're going to, get all your money back in 6 months and it's going to be this grand thing, but it's also just a safe, secure cash flow from day one. And right now that we're actually seeing some depressed prices, I think that there's a good opportunity in the market to just really perform over time. So for us,
you're using looking at strategies very similar to Grant Cardone, and Grant Cardone doesn't like BRRRRs. He doesn't think that's sexy at all. He wants to have the deal exchange and be cash flow positive day one.
Yep.
And that's the strategy that you're using.
It's boring real estate.
Boring sounds beautiful. That sounds sexy to me when it comes to real estate.
Yeah.
We've done so many of the other projects where you buy the property and, you're going to do this BRRRR and it's going to make this mad profit and, and capital appreciation. And you get started on the project and the plumber doesn't show up. And then you get on the project and then, there's something wrong with, you get a specific building inspector. And we all know who we were talking about back in the day. and, makes the project 10 times more complicated than it needs to be. And you run into these situations, and, now it's a lot better.
Yeah.
But the reasonability has hit the landscape again. And so you get these projects, but still you're going for 3, 6, 9 months without revenue on that property. And you're bankrolling all this stuff with the hopes that the refi is going to come out as exactly as you need. And then you're trying to go. What you're saying is, tell you what, why don't we just avoid all of that, get super boring, buy a property in day one, be cash flow positive.
Yeah. It's the path of least resistance right now. The deals right now are out there. Listen, in 2020, 2021, like it was very challenging to go and find those deals, right? Everyone was just overpaying for the basics of real estate. Your cap rates were depressed. Your cost per doors were insane. It was challenging to do that. So you had all these people do these fancy things to try and make deals work. And unfortunately, a lot of these people got kind of bit in the ass on that, right? Yeah. Either we see the environment change in terms of interest rates. We see the economic environment change. We see the rules of the game change in terms of what you're able to do for cash for keys, what you're able to do for financing. Like there's so many variables that can happen throughout a project like a burr. Don't get me wrong, they can work well. I built my portfolio at the beginning. I did a lot of that stuff and it can work really well. I just think it's about when that opportunity is there in the market. And right now, I think that, we're in a bit of a volatile market. We're in a bit of a volatile state right now. I think there's just good opportunity in going and finding good fundamental deals that make sense from day one. And your upside is still very, very good on a lot of these deals. Your gap to market from, the rent that it's at now, your gap to market rent can be fairly significant, which in the multifamily world obviously means your value can increase dramatically as well over time. But you don't have to go in and force anything to happen. You're not going to lose big if you don't make something happen. You're just going to keep collecting the cash flow. And so it's steady from day one. And over time, you're going to do really well and you're going to mitigate your risk. That's the number one thing for us right now.
So when we look at these deals where you're finding cash flow coming in the door, like that sounds beautiful. Where are these deals?
I'm looking all over Southern Ontario, primarily Golden Horseshoe. I do avoid the GTA because I find that you just can't get the cap rates where you need them. But we're looking, obviously Waterloo region. There are opportunities in Waterloo region. We're seeing them all the time. We just picked up a property in London that was an awesome deal. And we're looking at Hamilton. We're looking at Niagara. I've gone as far out as Windsor as well, although I'm put a pin in Windsor for now. I'm just with where we're at with our relationship with states and that border relationship. I don't personally love where that could be going. So I'm going to kind of put a pin in that one. But yeah, anywhere kind of these, Golden Horseshoe area and some of the markets in between, I think present a really good opportunity right now.
Well, what Kitchener-Waterloo and London are very similar is that they both don't really have geographic barriers that sit around them. So there's no, escarpment or lake or anything to contend with. So they have the ability to be able to expand. They are moving vertical. Kitchener especially is doing a lot of vertical growth, which is, I think it's a really good sign. Mm-hmm. And they're very economic diverse. You've got your insurance, you've got your universities, hospitals, and a lot of startups and just different manufacturing businesses in the area. So it's not like Cami goes on strike and the whole city stops.
Yeah, I think you hit the nail on the head with that, especially regarding Waterloo region. We tell our clients that all the time. It's such a diverse economy. It's not a one-trick pony town, right?
Yeah. And that's the thing that I love about those two areas. London's really interesting. And I want to talk about that London property because when we were chatting a little while ago, we were talking about your trade because you did a little bit of a trade on that. And you had one property and you're like, we're going to get rid of this one and get this one. So let's talk a little bit about what happened there in that process.
Yeah. So to take a step back, I started my portfolio doing a lot of duplex conversions, triplex conversions, fourplex burrs, right? Doing all of that kind of stuff. And then obviously once we hit the interest rate environment that we did, you realize those deals don't really work anymore, right? So you pivot and you start looking for different opportunities. Where I found it really started to get attractive is in the larger multifamily buildings, particularly in the ones about 16 units and up, I find to be much more attractive. The numbers just tend to pencil out a little bit better. Obviously we'd already built a portfolio at that time. We had a number of duplexes and stuff locally here in Kitchener. And we started to kind of calculate our return on equity in these deals. It's something we've been doing with a lot of our clients as well, is we really kind of break down their portfolio and say, okay, well, your portfolio has been great. It's looked really good It's performed really well, but it's here now. For instance, we're going to talk about this duplex that I ended up selling in order to buy this 34 unit building in London, right? We bought this duplex back in, I think it was 2020 for like 650 grand, a little bit less. We ended up selling it last year for 900 grand. We had over $400,000 in equity tied up in this duplex. And me and my partner, Zach, kind of sat back and looked at it and said, well, we got $400,000. Yeah, this duplex at the peak of the market was worth 1.1. Hindsight's 2020. Obviously, if we could go back and sell it, then we would. But we said, even if it were to get back close to that, even if it appreciated 100 grand in the next 5 years, we've made 100 grand on 400 grand, 25% in 5 years. That's not very good for what we're looking at in our market. It's also a duplex in an interest rate environment that doesn't allow it to cash flow at all. So it's breaking even at best. We're not even paying down the mortgage at this time, and we're simply just banking on appreciation. It was a lot of capital for us to have tied up in the place to just sit and kind of wait for it to appreciate to make our money.
I think that's one of the biggest challenges that people who buy smaller, single families or duplexes is that they are deceived by the numbers based on cash flow, and they don't tie the cash flow to the equity that's locked in the property. And as soon as you start, and I always use the example of if you bought a property for $100,000 cash and you made, say, $20,000 or say $10,000, we'll say, of rent, net rent, that means you made 10% on it. If you bought a property with $80,000 mortgage that say cost you $5,000 and you only put $20,000 down, and you made that same $10,000, the ratios that you're going to be making on that money is so much better because of the leverage that it's been giving you. It only cost you $5,000, so your return is actually dramatic, up to 25%.
Yeah, it's huge, right? People also get caught up on what their initial investment into a deal was, as opposed to the current equity that they have in that property, right? So somebody will invest in a property 5 years ago and said, hey, I bought this duplex and I put 100 grand down on it, or a single family home. I bought it for 100 grand and it's tripled. I got 300 grand in there now. It's been a great investment. Why would I sell it? Right? It's been great. I said, well, is it going to triple again? Right? In the next, is it going to triple again? Chances are no. And how does it perform over the next 5 years? So something we do is really kind of look critically at, our own portfolio and for our clients. And we look at it critically and say, well, this is how we expect that to perform over the next 5 years. And is that still the best vehicle to keep your money in?
Well, and as I own a mortgage brokerage, I know that while there's a few lenders that you can work with, that, when you get up those 10, 20, 30, single families or duplexes or whatever, the amount of work that's required on just the mortgage shifting to kind of keep those things together, even if you have one lender that'll do it all, just shifting everything around is just such a pain. And as your net worth starts to grow, starting to make small decisions becomes really problematic. And starting to shift those into larger, more useful investment vehicles where you can consolidate value and consolidate activity. One decision moves 34 units rather than 34 units require 34 decisions.
Exactly. And that's just it. It's so hard to scale from the financing side, and then just from a management side too. It's harder to manage. So it's funny, we actually have 35 units locally here through duplexes and triplexes. So our one purchase doubles our portfolio.
And it was just in the duplex bought that.
Yeah, and the duplex bought that. So we ended up selling our duplex. We pull our equity out, and we were able to structure our deal on the purchase of our 34 unit. We ended up going 95% loan to value with an MLI Select program. We did a 45-year amortization. We locked in our rate at 3.95%. It's cash flowing from day one. We bought it at a 5.3 cap, 180 a door. It just, fundamentals were strong. Good cost per door.
I want you to say those numbers again, because I was going to ask you that question to really hit on it. Because I think that's really important. And guys, when we look at cap rate is you're looking at the net operating income. You're taking that, you're using the purchase price and dividing the net operating income by the purchase price, and that gives you that number. And we see, what in Toronto, you might see caps of say, 2% or 3% or something like that. Whereas you're buying strategically, you're going to be buying it at better, in other words, a larger cap rate. Now, if you ever decide to sell it, you want to sell it at a lower cap rate because that means you're driving more value out of the property. But if you're buying, you want to be buying at a higher cap rate. So in this right here at a 5 point, you said 5.545. Like that's
5.3 cap on purchase. Yeah.
Yeah,
And
5.3
that
cap.
was
That's
just without
beautiful.
touching anything. Yeah.
With not touching one thing, buying at a 5.35 in Ontario is fantastic. Even in the States, you're typically maybe buying at a 6 or 8 cap. Your 8 cap's going to require some love.
Yeah.
Your 6 cap is going to be somewhere similar to what you are. Probably 5 to 6 is what we're seeing in a lot of the US that I hear from the deals that I see.
Yeah. Yeah.
Eights, you always know there's going to be something that needs to happen.
Of course. It's a relationship of risk as well, right? Like you kind of look at that, and markets that trade at a higher cap rate tend to be the riskier market. That tends to be the relationship there. And that's why, Toronto trades a really low cap, because people view it as a very, very stable market, and you get a lot of people just parking capital there, right? Because it's a safe bet for the big money out there.
And then the other thing that you did is you were able to take from a sort of having 34 different mortgages and going through the whole process, you were able to consolidate to get a single mortgage and using the MLI Select programs. And guys, the MLI Select program is a Canadian program run by CMHC that allows investors in multifamily to be able to buy properties at a really good interest rate. I think you said
3.95.
At 3.95. And it has some criterias about certain elements of the property that it needs to match. And based on those criteria, it gets a score. And based on being able to pass that score, you're able to use that property to move that into that program. And by putting it and locking it in at interest rates, you're getting a lot of value. Because what's the term that you locked in on that one?
5 years.
5 term. Okay, yeah. And so that means that he's protected for the next 5 years at that rate, but he's got a 45-year amortization, which means that he's able to produce better cash flows and carry that property in a more meaningful way. And if he's buying it where the property's values, the rates on the rents are sub what market value is, that means hopefully at the time of renewal, you've got a situation where you're renewing with the cap rate is a lot more effective because the rents are a lot higher.
Yeah, that's exactly it. So there is other things to this deal as well that, certain people overlook, right? So there's, for instance, on this one, none of the parking is included in any leases, and they're not charging for parking. Something we can do right away is just, start charging for parking. Okay, so we can go out and make a couple $1,000s a month just on parking. 12 storage units actually in this building, completely underutilized. They're just, it's a mess in there. The owners had just started storing some of their shit in there, and it just built up. And that was it.
Well, you already got a client then.
Yeah, I guess so, right? So, and there's little things like that. And it's with a little bit of love, you can start charging a bit more for that. So we intend to increase our income on this by at least a few grand a month, within the first 6 months of taking this. So there's upside there, but it's still cash flows from day one. And it's not like anything needs to happen. We don't need to go in there and turn over units. We don't need to go in there and increase rents. So it makes sense as it is. We can do what's easy, and there's money on the table, and then we just let time do its thing. And because we're so leveraged on this, it was such a cheap entry price for us.
Well, a cheap entry price from an interest rate as well. I mean, when you look at your financing on risk for somebody who's got 34 units buying another duplex, number one, you're going out and getting 35 tenant acknowledgements at 35 different properties, getting 35 mortgage statements. You're going out and getting 35, all these documents and that sort of thing and putting together. With this one here, you're just getting one and putting it all together. And then you've got a rate that's a super smashing rate. You also have third-party validation saying that this is a good deal, because an MLI deal is not going to go through if it's not a good deal.
Yeah,
so it's got to have good debt coverage ratio. It's got to be a good property. So in other words, if it doesn't qualify, you have to wonder and say, if the DCR is not working, why am I buying it? Where a lot of the other one, the duplexes, you're going to come with all of these other reasons that are going to happen in your head that just don't pass when you get to the larger units.
Yeah.
It's got to pass the sniff test. And that's a bonus. One of the things in our mortgage brokerage that we work on is something called suitability, and ensuring that the purchase is suitable. It makes sense for that person. They have a good strategy, and it's going to be something that works. And when you do these big purchases, you have a lot of eyes on it because you're moving typically a little bit larger amount of money. And so therefore there's more eyes on the prize to make sure that it's being moved in a more effective way.
Yeah, absolutely.
Yeah. And so now when we look at the larger one and we're saying, okay, we've got this one under wrap. I want to get back to great. You've now bought it. The big what next is that everybody worries about is how the hell do I manage something like that? They look at a big building like that and it looks really daunting because it's got a big flat roof on it. It's got a big parking lot. It's got all these people. It's got shared hallways, potentially maybe an elevator, maybe laundry in or outside of the unit. And it's got all this stuff.
Yeah.
What are you doing so that you don't have a haircut like mine after you bought that property?
Yeah, absolutely. So first off, we do manage all of our properties in-house. Now, again, with the underwriting process of these larger deals, you're always going to account for a management budget. Okay, so option one is you can absolutely go out there and hire a property manager, and it shouldn't change the fundamentals of your deal because you've already accounted for it, right? You look at the smaller deals, and a lot of people don't count for management, maintenance, all of these things that really add up,
Vacancy.
especially over time, vacancies, CapEx, all of those things, right? On the larger deals, like you're doing that in your underwriting from the beginning. So first off, if you're that scared, you can definitely go out there and just hire someone else to do it. Now, we manage all of our own properties in-house, and I want to kind of talk about how it's not as scary and as daunting as it seems. It's no different than, managing a duplex. It really isn't. Honestly, it's actually significantly easier for us to manage this one building than our whole portfolio here in Kitchener, where it's, spread across multiple properties. You've got multiple roofs, multiple furnaces, multiple driveways, multiple lawns, multiple different tenant problems in different areas.
Multiple
right?
neighbors.
Multiple neighbors, it multiplies, okay? It's much easier to kind of just consolidate all of that from a management perspective. We use a software that really helps. There's lots of property management softwares out there. So we can do all tenant communication through this, okay? So you don't have to be a property manager and just field calls from tenants all the time. I always get this question from people like, how do you deal with all the phone calls? I don't. We communicate through our tenant app. That's it, right? Unless it's an emergency, in which case we have an emergency line that they call. If it's not an emergency, we go send us an email or communicate with us through the app. Everything is done that way and it's systematized. If you break it down and you just use a system for your property management, it's actually not that complicated. And yeah, stuff's going to happen. You're going to get questions with your tenants with questions and concerns, and you'll occasionally have to deal with non-payments, late payments, all of that stuff. Okay, it happens. It's not that daunting. I find if you're new to it, hire a paralegal from day one. If you have a non-payment, don't represent yourself. Okay, you're already saving
that's
yourself.
rule number one.
Rule number
I
one.
would just say that right there is, if anybody right now has property and you're like, I've never dealt with the landlord tenant board before, the tribunal, and I'm just going to go do it myself. The first time you hit it, just don't.
Yeah,
Just don't. Hire a
don't.
professional for that one. Because if you get one dot wrong, one T not crossed, one of those fields not filled out correctly, your file's going to the bottom of the list. You're not getting paid for another 6 months.
Yeah. And it's if everything's done correctly, it's not as bad as some investors make it seem. Everyone hears these, oh my God, it's been a year. It's been multiple years me trying to evict my tenant that hasn't paid. How many times have you made a mistake at the LTB? There is no way. And I've been down this road. It's first off, so I've been a landlord for years now. I've had multiple units. I've had one tenant not pay me to the point where I had to actually evict them. Okay. I've had, late payments before, and I've served multiple notices for eviction. Only once have I actually had a tenant that didn't pay and was just like, no, and it was, during COVID when they said they weren't going to evict, and then that changed. And it was this whole thing, when somebody really clearly tried to take advantage. But other than that, that's one over multiple properties over multiple years. So first off, I'd like to remove the stigma of Ontario sucks because people don't pay and you can't do anything about it. Because if you look at the ratios of that, it's very, very small if you screen your tenants properly and you do the right things.
Well, I think if you screen your tenants properly, number one, and then number two is you treat your tenants fairly.
Yeah,
because at the end
people,
of the day,
right?
your tenants, this is their home, and they've chosen out of all the properties in all the world to live in your property, and they've chosen to support your real estate investment endeavor by occupying that property as their home, and to treat them as people living in a home. I think you're going to get a lot better relationship than if
Always.
it's just tenants.
Always. Yeah, and I think that goes across the board. I think if you have good relationships with people, you'll always get more out of those relationships than if
Yeah,
you're trying to butt heads, right?
totally agree with that.
Like
Totally
I think
agree.
that's kind of across the board. Yeah, with our tenant the one time we hired a paralegal. It was uh like 6.5 months and they were out. Okay. And they ended up owing me, I think it was 10 grand, something like that. Which sucks. Don't get me wrong. It's 10 grand, but you look at that in the grand scheme of things, it is a drop in the bucket of even now, it is a drop in the bucket of the monthly rent roll. Like it's
Yeah.
not catastrophic.
Yep.
It's a cost of business. It is what it is. Like I said, it was 6 months. And yeah, it was annoying. It was an inconvenience. I also didn't let it get to me because you hire a paralegal to deal with it, you're not then so mentally drained with dealing with it that it takes away from everything else that you've got on the go. Because if you were to try and do it yourself, and A, it's the time to do it, B, it's the mental strain and capacity it has on your kind of your mental well-being and your ability to go out there and still perform in everything else that you're doing. Right. So I highly recommend you just hire a paralegal, deal with that right away. And that's it. Above and beyond that, property management is not super complicated. It's not always easy at times, but it can be fairly simple if you have the right symptoms or systems and you just follow the systems.
Now, one of the systems I think most people avoid, and I see this mistake happen both in the investment space, and most important, I see this happen a lot of time in the single family space when they're buying their principal residence, is you used a word earlier on, which I thought was a really important word that people focus on, which is the CapEx.
Mm-hmm.
Is the idea when you buy a property, you need to start to allocate a CapEx budget.
Yeah.
And I want to talk a little bit about that, both on the single family, I'm just buying this to live in this house. I need to be thinking about this as well as the investor. Talk a little bit about what CapEx is.
Yeah, so CapEx, I mean, it's short for capital expenditures. It's money, it's investment in the property that you're going to have to make, often related to mechanical systems and structural elements of the home that aren't necessarily going to add immediate value or change the income of the property or add the property, but they need to be done to maintain the state of the home. Okay, things like your furnaces, your roofs, your boilers, your water heaters, sometimes your electrical systems or old fuse panels and things like that need to be upgraded. These are all what would kind of fall into CapEx. On larger buildings, we're looking at parking lots, windows, all of these things that you're going to have to spend money on at some point. It's not if, it's when. Okay. And if all of these things have been done, okay, we can say that these things have a certain lifetime of this, then I'm going to have to replace it. It's going to cost X. Okay. We've got this much time until we get there. Let's divide that amount by this much time and start putting money away from that or for that so that when the time comes, it's not this massive expense. It's just been a little bit for that time, right? And on the single family home front, those are things like, your roof, your furnace, the furnace goes in the middle of winter, you're dropping 5 grand on a new furnace like that. They're coming out right now because you need it, right? Be prepared. If your average homeowners out there, if you're looking to buy a property, there are expenses to it. Listen, owning real estate is great. And I think that it does very good things, generally speaking, to your net worth and, your overall financial well-being. I think there's tons of positive to it, but don't be fooled in thinking that there's no additional expenses to come with that. You should be able to kind of pick up stuff in a home inspection or just, based on age of certain aspects of the home or property. On these larger buildings, you do like a building condition assessment on purchase. They will tell you in every single line item, they'll say this is the expected life expectancy of this aspect of the property. You also have a life expectancy of the building, essentially, that the lender will rely on, because if they're going to give you a 45-year AM, they need to be sure that the building's still going to be around and operable in 45 years, right? So all of these things, you'll kind of be able to break that down. And again, you can reverse engineer how much money you need to be putting away for certain things when it's due. If you just plan ahead, it's the importance of planning ahead.
So that sounds very suspiciously like a condo fee.
I mean, it is, but you have full control over it. So there's that.
Yeah, there's the control side. But the thing that I was alluding to is the idea that at any point when you're running your building as a duplex, as your principal residence, or a 34 or 300 unit apartment building, you need to be setting aside that money, like your own personal condo fee. It's great that you control it, but your own personal condo fee, so that you're setting that aside so that when that problem arises, it's a budgeted event it's not a surprise. And, oh, I got to whip out the credit card. And so that puts it so that it actually doesn't hurt. It just feels like, yep, I planned for this. I'm so glad that I did. And it just happens as accordance. Like, as you say, you've offloaded the problem to the paralegal. It's just things are happening in due course, and the same things
Yeah.
need to happen with these.
It's just the
CapEx
next
events.
step then. It's expected.
Yeah, that's right.
Be prepared. It's the next step.
Yep, just to plan that out. So I think that's something really for people to dive in on it is to know that they do that. Now, you also use a word, you said control, and I want to talk a little bit about control, because when we start getting into, a lot of the investment side, there's different ways to get into the deals. I hear a lot of people, I own 300 units and I own 5,000 units and I own all of these things. And then you really kind of start to dive into it and you're like, well, you've got a JV agreement, 30 properties that your name's on any of those titles. Do you actually own those, and where's your exposure and risk on these things? And I want to kind of talk about all the different structures that are out there just at a very high level.
Yeah.
And some of the advantages and risks.
Yeah, of each different thing. So there's always investing in real estate, or whether you're a partner for someone else or doing it yourself, there's different ways to do it, right? You can go out there and buy the asset itself, have equity in that, and then your return is based off how that asset appreciates and performs over time. Or you can go like the lending route, you can do second mortgages, private lending, all of that stuff, right? Where it's simply just an interest rate return that you're getting for that, right? So on the equity side, this is where people do joint ventures. So someone will say, I need somebody to go and get a mortgage. I've got half the down payment. I'm willing to do all of the work, but someone's got to go on the mortgage. We'll sign this joint venture agreement, which is essentially a side agreement, nothing to do with title of the property. It doesn't cross the lawyer's desk on closing. The lender typically doesn't know about it, because if they did, they would want everybody involved into everybody's documentation, as you know. And it's essentially just this side agreement that is a contract saying that you own 50% equity and you may be responsible for 50% liabilities as well. The issue with something like that is obviously nothing is registered on title. It's just this side agreement. You see people do joint venture agreements in just shell corporations and all these different things where there's very little recourse for the person on title or for the other party should shit hit the fan, for lack of a better term. The other way to do it is obviously you're looking at your standard corporation.
Well, before we move on to the other ways, let's just close off the joint venture one. The joint venture one, wherever I've seen the most amount of peril, it's in the joint venture one. Mm-hmm. And usually it's because the money person is the one who's on title. The sweat equity person is the one who's on the JV agreement. And I've heard time and time again, they're like, oh no, my joint venture agreement is registered on title and it's been done with the lawyers and this. And I'm like, okay, yeah. And the only time I've seen people really get hit on agreements is in the joint venture side, and they lose big. Yeah. Because joint venture side is very similar to the prom note side that happens in this industry. Yep. Where, you're not secured against anything. You are lending on vapor and you are investing on vapor, and you've got to hope that handshake agreement is going to hold true.
Yeah. It's essentially a documented handshake, right? And you kind of nail on the head there with, on the lending side, you've got private lending and you've got like second mortgages and being in a position registered on title for that mortgage and that loan, or you've got promissory notes, which again is just an agreement saying, hey, I've lent you this money. I agree to pay you, or you agree to pay me X percentage and then pay me back by this time. But if they don't, what is the recourse of that? It is very, very challenging to actually follow up and get your money back. If the person goes bankrupt, if they close that corporation, there's a lot of different ways where people can get screwed on that. And it's very similar to a JV. If you're going to do any private lending, I highly recommend you do it as mortgages, registered on title. You're protected then, right? See if you can walk people through exactly how you're supposed to do that, what percentage of loan to value it really is safe and secure, and here are your risks, but at least you're secured against the asset should things go sideways.
You have an interest in the property that is registered, where if you have a prom note and this was very prominent over the past few years when the market was going crazy, you had a lot of people who were consolidating a lot of money through prom notes, and they were kiting from one prom note to the next note so that this person's prom note would pay this person's prom note. And there's no regulation around it. Whereas when it's a mortgage, it's a regulated event. It happens. It gets registered on title. It's
Mhm.
known, it happens, and you're protected because you have an interest in the property. And I think that's something that's really interesting. Now, if we don't go from the lending side and we go more to the equity side, there's some structures that need to happen when it gets set up. Let's talk a little bit about what those structures could look like.
Yeah, so the proper way to do it, if you want to be on the equity side as a partner, or if you're the active person trying to find partners to put deals together and kind of syndicate some deals here, you got to go pretty much to the corporation where every owner of the property or of the corporation that owns the property is going to be like a shareholder, and they're going to have shares of that corporation, and they can be allocated their percentage of shares of ownership. Then
So that's a
outside of
single
that,
share structure. Everybody's the same class and everybody
yeah,
has
you
a
can do it
percentage
the
ownership.
same class, or you can do different classes. Talk to your lawyer, and it'll depend on how you want to structure your own deal. You can even do non-voting shares. You can do a lot of different things. The important thing is that everyone has shares, and everyone is then a registered owner of that corporation, and the corporation is a registered owner of the asset that you're invested in, right? So you are then, in essence, registered on title of that asset, and that's going to keep you protected, right? Outside of the shares of the company, you're going to have something called a shareholder agreement, which is essentially just an agreement that outlines what happens when. If things go wrong, if there's cash calls, if someone dies, if there's divorce, if there's disease, if there like all of these things that will outline all of the scenarios, when you're going to get your money back, how you're going to get your money back, what the plan is on when to sell. Like you can go into all of these details of the investment. So it's all clearly written up front so that there's just, none or less surprises down the road, right? It's really important to document all of that up front. That will also talk about how you vote on your directors and how you go about all of these other things and who are the decision makers, who has authority up to what amount of money to make decisions on things, who decides to sell, who decides when we refinance, what happens with those funds. Like the shareholder agreement will outline absolutely everything. And honestly, every individual shareholder should have their own lawyer review it, is how the way I would recommend doing it. Everybody has their own lawyer. Everything's above board then. It's a little bit more expensive and time consuming, but as we get into these larger deals, again, it's a drop in the bucket and it keeps you protected. It's the right way to do it.
Well, it's
So
the right
I
way to do it
recommend
on the smaller deals. It's just there's not a lot of meat. There's not enough meat on the
there can
bone
be
to make
less
it
meat on the
happen.
bone. That's the only thing. And you can listen, you can simplify it. You can really have a boilerplate shareholder agreement. Like there's a lot of like simple ways to do it. I would just recommend that, you have your lawyer look over those documents, make sure that it's done right because it's important. The other way to do it is like a GP LP, so that's a general partner limited partner, where basically the investors come on as limited partners. The general partner, being the GP, will come on as well. They will take responsibility for everything happening with the property, so they'll typically guarantee the loan. They will deal with the day-to-day operations of that. They'll find the deal, they'll put it together. They'll deal with everything. And the limited partners actually aren't allowed to deal with anything because then they kind of cross that line of their limited partnership where they're not liable for anything other than the money they invest into the deal. So that's kind of the other structure to do as well. You see that on typically much larger deals. That is a more expensive kind of system to set up, but you see that is pretty common. That's how like REITs and MFTs are kind of set up in a similar fashion to that. The GP will also typically take a cut of the deal or have shares of a GPLP. They're units, they're not shares, but they'll get a certain amount of units for being the GP. The LPs will then buy their units at a certain dollar value, and that's how the money is raised to go on and do the deal.
Yeah. Yeah, and raising capital in that way is you see that a lot as a very standard way of raising capital in the United States, especially, and then across Canada. As we start to see, more bigger stuff come on the market and transacting, I think that's definitely something. I think a lot of the new buildings that are coming out, there's a lot more opportunity for that. Now, when we look at classes, that's one thing I want to kind of think about when, you talk about risk earlier on and we look at the type of properties. So in the States, you've got class A, class B, class C, class D, and the different styles. What sort of classes are you seeing in Canada in multifamily?
So it's similar. We look at, based on neighborhoods, based on, the type of build, the year of build, different markets in general as well. I would say just have kind of different class assets in them. I mean, if you were to go to something down in Sarnia or something in a nice neighborhood of GTA, just by location, I would consider it to be a different class. we would class it in the similar sense to what they would do in the States. Typically, I think that, I like that, like B class, honestly. That's kind of where a lot of it really makes sense. Maybe between the C and the B, on the upper side of the C, if you can kind of push it into the B over time, just by doing small improvements. Purpose built is really important to me. I don't like the hacked up.
In homes?
Yeah, like that to me immediately kind of puts it at a lower class. You're going to get a lower class of tenant. You're just going to have more problems with it overall, through my experience and from what I've seen. Right in that like B-ish class, I find you're still getting really good cash flow. Your tenant profile is still going to be good, something that you're comfortable kind of managing, but you're still able to get, the decent loan to values. Once you get into like the new build, almost class as A class, new class in a nice neighborhood, they're very expensive. Again, they can do well over time, but you tend to get people that are more parking capital there. And I think that it's more of a safe bet. To our talk earlier on cap rates, you're going to buy that stuff at, closer to a 4 cap, maybe less, maybe a 3.5, right? As you get further down, you're going to kind of increase your cap rate a little bit. Right around that B class is where I think most of it trades around a 4.5 cap. But if you can find the ones at a 5, the numbers really start looking attractive. And I'd say a C class,
as soon as you
around
get above the 5 number,
cap,
you can
you're
play a
good,
little bit better,
right?
for your
And then,
DSR.
you can get to your lower C and D class where your cash flow might be really good. Like I looked at the deal up in Owen Sound recently, and it was less than 100K a door. It was at face value, I was like, poof, okay, this could be nice. We're over a 6 cap. This looks great. I did a bit more digging on it. I'm like, man, this place is a dump. Like I want nothing to do with this. And then you actually start calculating the actual maintenance costs and all the other costs associated with it. And it tends to drive that cap rate down a little bit just with all these additional costs. So I just don't see the upside on that. So I really
think
like
some of the
that.
other de-risking things that you did as well when you're looking at your markets is, what's the employment look like?
Oh,
And it sounds
100%.
beautiful. It's a great spot, and you just have to make sure that you're not exposed on employment based on what the average income is.
Yeah. That's exactly it. Something else I really like to focus on when looking at deals too, because it is the gap between current rents and market rents. Okay. I actually prefer something that's kind of in that middle, that's actually still got good room for upside. You can find some stuff that's over a 5 cap, but it's just been renovated. So their market rents are all $2,000 a month, $2,200 a month for their 2-bedroom units or whatever, maybe $2,000 a month for their 1-bedroom units. And they're really at that like top end rent. Okay. So you may be able to get it, this beautiful building at a good cap rate, and it might work. The risk with that is that over time, are those rents going to hold up? If rents soften, is it still going to perform? Are you going to be able to keep it occupied at those prices? Is your vacancy going to increase because you're trying to charge this premium rate? There's all those things that I look at. If you find one that, average rent for a 1-bedroom is $1,800 a month, and your average rent is $1,500 a month, but you're still at a 5 cap, the numbers still work on the financials today, you're only going to go up from there. Whereas some people will say, well, yeah, it's at a 5.2 cap. It's great. But every single one, again, maybe average market rents, 1,800, but they're getting
the pedals
19.
to the floor on the rents. And,
exactly. So like your risk to me is slightly higher there, because if something does happen with the rents, you could be getting less next time, or it could take you longer to fill it, because when you go to market at 1,900, all these tenants are looking at stuff between 16 and 19. You're that top one. It might just take you a couple months to fill it. All right. Have you counted for that vacancy? Have you looked at that? So I like to look at it again around that like B class, maybe like high C class, where the gap to market rent is still pretty substantial, where there's still room for real lift, but we're buying on today's financials at a good cap.
Yeah. No, that's so important, because you're looking at the inertia that can happen there. And you could look at it 2 different ways. It's inertia based on the differential to market rents, or you can look at it as the cushion, because that's the thing that protects you, so that if there is vacancy, you're not sitting with a unit 6 months because you're trying to hit that maximum threshold.
Exactly.
And you can drive to get that really good tenant, even though it's maybe a little sub market rents, you're still getting a great tenant and you're still making your cash flow. Yeah, that makes total sense.
Yep.
I love that. Now people are listening going, great, I feel a little bit more comfortable with that there's actually deals in Canada. I don't have to get a US passport. They're looking, saying, Kitchener-Waterloo, London, that sounds great. These are great markets. Maybe a little less fearful property management, understanding of a little bit of difference around structures. I'm going to give you two people who could be listening right now. And these two people are going to look at, how do you find these deals?
Well, how do we find these deals? A lot of hard work and persistence. Okay, so find these deals. So these larger deals, honestly, a lot of them happen not on the MLS. It is a lot of direct to seller relationships, and is a lot of agent to agent relationships that I just built over time. Like that, honestly, is a big one. I find a lot of sellers in this space don't want their tenants to know that it's for sale necessarily. They don't want them to, or they don't want to have, a substantial amount of unnecessary showings to disturb the peace with their tenants or whatever. They just don't want to deal with that. So they'll hire an agent to go out there and find them buyers. And as agents that are active in this space, we do a lot of networking. We're always kind of shaking hands, meeting people, staying in touch. So there's a lot of deals that kind of trade hands that way. That's how I got this deal in London. And then, direct to seller, we do a lot of marketing, kind of driving sellers to us. And just
so what you're saying is, and I think this is a very meaningful statement. What you're saying is to find the best deals, you got to be committed to be working in the space.
Yeah, you do. And surround yourself with the people that are in that space. That is a big thing for me. And something that we've focused on over the last few years, especially once we decided that we want to go to bigger deals, we just start hanging around people doing bigger deals.
Yeah.
Right.
There was a study saying that, if you can surround yourself with somebody who's successful, generally you're going to find a lot more success. If you surround yourself with people who are not successful, you're going to wonder why you're not. And if you want to be successful in the multifamily space, you've got to be in it. You've got to be going to the Wealth Genius events. You've got to be going to the Jake and Gino events. You've got to be going to all the capital raising ones, and just start getting to see who's out there in the space and who is actually playing these deals and what are they doing. And because everybody's doing a deal, they're either offloading a deal or they're getting a deal. And you're going to be looking for the good one. And I think, by playing in that space and making it very purposeful, number one, if you're giving advice as a realtor to people on buying investments, you probably should own some.
Yeah.
And because then you're giving it advice about something that you actually know that you're talking about. If you're going to be doing in the multifamily space, you should be owning some multifamily, and that should be the thing that you're playing in, because if you're in it every day, you're going to be the person who's going to command the knowledge around it. If you're not in it every day and you're just kind of dipping your toe in, I highly suggest working with somebody who is.
Yeah, 100%. I couldn't say it better. It's shocking to see people going out and selling something and saying that it's great and then not doing it themselves for some reason. I don't get it. No. Yeah, we practice what we preach, right?
Yeah, that's exactly right. And I think that's super important for people to look at that and really take that to heart. And look, everybody's got a starting point. There's got to be that moment where you're just, I'm going to go in this direction. I want to do it. Go in the direction with somebody who is doing it. And I can't stress enough that I believe that in the real estate space, and I certainly believe in the mortgage space, it needs to be an apprenticeship so that people are working with experts. They're not working with people who are part-timers, who they got their full-time job somewhere else. This is a side hustle because they're looking for quick cash. And I think that's not what this industry is about. This industry is about professionals. There's so many great people in this industry who are taking this very seriously. They take their client success very seriously because they're in it full-time, doing this job full-time to make sure that their clients are well looked after, make sure that they have the right information at the right time, and that they're capable. And I think that's what you've definitely demonstrated. We've known each other for quite some time. It was great actually to connect at an event again. And dude, it's been absolutely fantastic to have you on the show, man.
Yeah, I really appreciate it, man. It's been a pleasure being here. We'll definitely stay connected, and yeah, this has been great, man. Really appreciate it.
Yeah, I'd love to have just some routine checks on just what the market's doing locally. I think that's so critically important for people to see that Canada actually, the door are open for investors. It's not as scary as you think. I mean, we've only had one person who was late on rent, and they've made it up in spades, and that's over since 2005.
Yeah.
And so, it's not as scary as what you think. Yeah, there's the landlord tenant board. Yes, it's something that I don't understand, but that's why there's professionals that you work with who deal with that every day, put that in their hands and deal with the professionals.
That's just it.
Yeah. Beautiful. Matt, thank you so much. And guys, if you want to reach out, it's Phipps Britain is what you'd be looking for on the internet. And I would go to their website, phippsbritainrealestate.com. Check him out there. He's a guest on so many podcasts. He gets out there. He gets himself known. He's at all the events. He's in the space. Get to know Matt Phipps. He's your guy when you go to commercial real estate. So Matt, thanks so much. Guys, this is the money. This is the mindset. This is the mentoring podcast. We'll see you on the next one.